January 23rd, 2026 will quietly go down as one of those days markets remember later. Silver crossed $100 an ounce. Not as a forecast, not as a rumor, not as a what if. It actually happened. For decades, that number sat in a strange place. Talked about, joked about, dismissed. Too high to be taken seriously. Too unrealistic to plan around. I still remember when people laughed at $50 silver, let alone 100. Back then, silver was called just an industrial metal. Something useful, but not monetary. Something you traded, not something you trusted. And yet here we are. Silver didn't hesitate. It didn't stall for long. It didn't ask for permission. It moved straight through a level the market had quietly treated as untouchable. I had to stop for a second and look again. Not because I didn't believe the screen, but because moments like this usually don't arrive with fireworks. They arrive calmly, almost uncomfortably. And that's what makes today interesting. Because when a market crosses a boundary it's avoided for decades, the real story usually isn't the number. It's what that number represents. So this episode isn't about where silver is going next. It's not a price target conversation. It's not a victory lap. And it's definitely not a promise that silver will keep going up in a straight line from here. What this is really about is behavior. Specifically, how markets behave when pressure builds quietly underneath the surface, and how certain assets start reacting before the system openly admits their stress. It's a story about the signals hiding in plain sight. This isn't just about a metal. It's about what happens when a market finally wakes up to a reality it tried to ignore for years. What we're seeing is a shift, a crack in the foundation that was there all along. Today, we're going to explore what that crack means and why the quiet, calm move through $100 might be the loudest alarm bell the market has heard in a very long time. Thanks for watching, and if you find this perspective valuable, be sure to subscribe for more. Silver crossing $100 matters, and it's probably not for the reason you think. The story isn't the number. It's how we got there, how fast it happened, and what didn't happen along the way. You see, prices tell stories, but behavior tells the truth. And right now, silver is behaving very differently. Most of the conversation stops at the headline. Silver hits $100. That's the part everyone sees, the screenshots, the reactions, the excitement. But markets rarely tell their real story at the headline level. The important details are usually hidden just beneath the surface. Very few people are talking about how silver actually crossed that level. Think about it. There wasn't a long, drawn-out technical struggle. No dramatic rejection or cool-down period. On the institutional side, prices stayed firm even as spreads widened slightly. That's a quiet signal that liquidity was being absorbed, not freely exchanged. That's not what a relaxed, healthy market looks like. Then, look at the futures market. Silver contracts blasted through 100 before physical retail prices in the U.S. even had a chance to fully adjust. Volume surged, but open interest didn't collapse like it usually does when a big move is considered finished. The market structure was lagging behind the price, another subtle clue. And we can't ignore the international picture. While all eyes were on the U.S. charts, silver in China was already trading at a significant premium when converted back into dollars. This wasn't just a momentary spike. It was a persistent gap that held across multiple trading sessions. That kind of premium doesn't just come from speculation. It comes from real, urgent demand that can't be put off until later. Individually, any one of these details might seem minor. Markets do strange things all the time. But when you put them all together, the speed without hesitation, the futures leading the physical market, and international premiums refusing to back down, the pattern becomes clear. When a market stops hesitating and just moves, it's a sign that something underneath is already under immense stress. And that, my friends, is where this story truly begins. So, before we go any further, it helps to slow this moment down and lay out a mental map of what's actually unfolding. Because this story doesn't move in a straight line. It starts with the obvious, silver crossing $100, a psychological threshold that existed more in people's heads than on balance sheets. But what follows that moment is where things get really interesting. There's no long pause, no clean reset. The price just keeps moving, even as the market structure struggles to catch up. From there, our attention shifts to speed. Not where silver is, but how quickly it's getting there. The compression of time between price levels starts to matter more than the levels themselves. That's when acceleration becomes a signal, not just a statistic. And then the lens widens. Gold keeps climbing in the background, quietly approaching levels that were once considered extreme. At the same time, the gold-silver ratio starts shrinking faster than most people expected. Suddenly, this isn't just a silver story anymore. It's capital adjusting its internal math. And just when you think the narrative is complete, another layer appears. China starts trading silver at a premium and holds it there. The physical markets refuse to follow the assumptions of the paper markets. What looks like simple enthusiasm from a distance begins to look a lot more like pressure up close. Each of these elements points in the same direction, not toward a guaranteed outcome, but toward a shared condition. This isn't a tale about one asset breaking out. It's about an entire system responding. When silver crossed $100, most reactions focused on the number itself. It was round, clean, and easy to repeat. But markets don't really care about round numbers. People do. What markets respond to is stress, imbalance, and urgency. And that's why the behavior around $100 matters more than the level itself. In a calm environment, these psychological barriers act like speed bumps. Price approaches, hesitates, pulls back, and tests conviction. You see rejection, you see breathing room. But that's not what happened here. To really understand this response, we need to break it apart, piece by piece. Stay with us as we dive deeper. Thanks for watching. That's how liquid markets behave when supply and demand are still negotiating with each other. That didn't happen here. Silver didn't linger under 100. It didn't bounce repeatedly off the level. It pushed through, held above it, and continued trading as if that line had already been mentally erased. Even more telling, institutional pricing didn't snap back into balance afterward. Bid-ask spreads widened slightly instead of narrowing, a subtle but important detail. In relaxed markets, spreads compress as participants gain confidence. When spreads widen while price advances, it usually means liquidity is being absorbed faster than it's being offered. That's not excitement. That's pressure. And pressure shows itself first in how fast a market moves. If you look back at silver's climb over the past several years, the contrast is stark. The move from $20 to $30 took months. Long stretches of sideways action. Plenty of time for doubt. Plenty of opportunities for sellers to reassert control. Even the journey from 40 to 50 wasn't immediate. It took patience, but something changed as silver moved higher. The distance between price milestones began to shrink. The time it took to gain $10 compressed dramatically. What once took months started taking weeks, then days. The jump from 80 to 90 arrived quickly. 90 to 100 came faster still. That compression isn't just a fun chart to share on social media. It's a message. Speed carries information that price alone can't. In markets, acceleration often appears when participants stop asking whether they should buy and start worrying whether they can buy later at all. That shift doesn't require everyone to agree on the future. It only requires enough participants to feel that waiting carries its own risk. And this is where the futures market quietly adds another layer to the story. Silver futures crossed $100 before physical retail pricing in the United States fully reflected the move. That's not unusual in isolation. Futures markets are designed to react quickly. But what followed is what deserves attention. Volume surged as price advanced. Yet open interest didn't collapse the way it often does at the end of a crowded move. In many speculative spikes, you see volume explode and then fade as positions unwind. Here, the structure lagged the price instead of resolving it. In plain terms, price ran ahead while the market machinery struggled to reorganize behind it. At the same time, short positions technically remained available. There was no absolute shortage of contracts to bet against silver. And yet, very few participants stepped forward to do so. Not because they couldn't, but because the risk-reward equation no longer felt rational. When a market moves quickly through levels once thought impossible, standing in front of it stops feeling like analysis and starts feeling like defiance. This is an uncomfortable phase for markets. When opposition thins, volatility doesn't disappear. It changes shape. The absence of confident sellers doesn't mean risk is gone. It means risk is being postponed. While much of the public discussion stayed focused on silver alone, another signal quietly developed alongside it: the gold-silver ratio. For decades, this ratio has acted as a kind of internal compass for precious metals. Not because it predicts prices, but because it reflects how capital is weighing relative trust between assets. As silver surged, the ratio compressed sharply, dropping below 50 ounces of silver to buy 1 ounce of gold. That move happened faster than many long-term participants expected. Historically, when the ratio moves this quickly, it's rarely about enthusiasm for silver alone. It's about capital recalculating where stability actually resides. Gold, in the background, continued climbing toward levels once considered extreme. That context matters. Silver wasn't rising in isolation. It was rising alongside a broader reassessment of monetary anchors. Past cycles offer perspective here, but not comfort. In 1980, the ratio compressed dramatically, eventually reaching levels that now look almost surreal. The aftermath was violent volatility, not a smooth resolution. In 2011, the ratio again tightened before reversing sharply as conditions changed. In both cases, the compression itself wasn't the destination. It was the signal. Ratios move before narratives do. And while Western markets debated interpretation, physical markets elsewhere were already casting their vote. In China, silver traded at a meaningful premium when converted back into dollars, not as a fleeting anomaly, but as a persistent condition across multiple sessions. That detail tends to get brushed aside by those who view futures markets as the primary arena. But physical premiums are stubborn things. They don't respond quickly to sentiment. They reflect real-world demand meeting real-world constraints. This lead-lag relationship isn't new. In multiple precious metals cycles, Asian markets have reacted earlier to shifts in physical demand, while Western pricing caught up later through financial instruments. When that pattern appears, it suggests that price discovery is happening where the metal actually moves, not just where it's promised on paper. Paper sets expectations. Physical sets limits. And when physical markets refuse to cheapen, paper markets eventually adjust, sometimes abruptly. By this point, it becomes clear that focusing on silver alone misses the larger picture. The metal isn't acting as a hero asset or a savior. It's acting as a sensor. Sensitive, reactive, and prone to exaggeration under stress. That sensitivity is precisely why silver often behaves this way during periods of monetary strain. Institutions that study systemic liquidity have observed this pattern repeatedly. In stressed environments, assets that are both liquid enough to trade and volatile enough to move tend to respond first. They don't cause the stress. They reveal it. Silver fits that profile almost perfectly. It's more volatile than gold. It straddles the line between monetary and industrial demand. It's traded globally, but not buffered by the same reserve status protections. When pressure builds quietly in the system, silver feels it early. This is why the behavior around $100 matters so much more than the milestone itself. The market didn't celebrate and rest. It absorbed supply, widened spreads, compressed time, and shifted ratios, all signs of adjustment under strain rather than balance under confidence. And that brings us to the most important distinction of all. This move doesn't need to end tomorrow to be risky, and it doesn't need to collapse to be meaningful. What matters is that the market has entered a phase where traditional signals lose some of their clarity. Volatility becomes the language. Behavior replaces forecasts. When markets reach this stage, participants often make the same mistake. They focus on whether the move will continue instead of asking why it accelerated in the first place. Silver isn't answering that question directly, but it's pointing toward it. And to understand what it's pointing at, we need to shift our perspective away from silver as a cause and towards silver as a symptom. At this point, it's tempting to frame silver as the driver of everything we're seeing. The catalyst, the spark, the asset that somehow broke the system. But that framing gets it backward. Silver isn't leading this move because it's special. It's leading because it's sensitive. In periods of genuine monetary stress, markets don't react in neat hierarchies. They react through the assets that feel pressure first, the ones without deep institutional protection, without reserve currency status, without the illusion of permanence. Silver sits right in that category. Liquid enough to trade, volatile enough to move, exposed enough to react quickly. That's why silver so often behaves like this at turning points. Not because it causes instability, but because it reflects it. Think about what didn't happen. There was no single announcement that justified this move. No dramatic policy shift. No official declaration that suddenly made silver worth more. Instead, pricing adjusted quietly, almost mechanically, as if the market was responding to a condition it already felt but hadn't named yet. This is how stress shows up in complex systems, not as a headline, but as a series of reactions. Certain assets begin to move faster than expected. Ratios compress. Physical markets stop cooperating with paper assumptions. Liquidity becomes selective. Institutions that study systemic behavior have long observed this pattern. In stressed environments, repricing doesn't start with the most stable assets. It starts with the most responsive ones, the ones that don't wait for permission. Silver didn't ring an alarm bell. It acted like a sensor, and sensors don't explain the danger. They simply register it. Once you see silver that way, not as a prediction, not as a promise, but as a signal, the entire move takes on a different meaning. The question stops being, how high can silver go? And becomes something far more uncomfortable. What kind of system produces this kind of response? A useful way to think about what's happening right now is to stop imagining markets as charts and start imagining them as systems under pressure. Picture an old pipeline carrying water through a city. For years, the pressure inside stays manageable. Small leaks appear, get patched. Valves open and close. Everything looks fine from the outside. But pressure doesn't disappear just because it isn't visible. It builds quietly, distributing itself unevenly across the system. Then one day, a weak joint gives way. Not because it caused the pressure, but because it felt it first. Silver is that joint. It doesn't have the thick reinforcement of gold. It doesn't have the political insulation of reserve currencies. It sits closer to the edge, where fluctuations are sharper and tolerance is lower. When pressure inside the monetary system increases, silver doesn't absorb it gracefully. It reacts. That reaction isn't explosive at first. It's fast. It's awkward. It's messy. Prices move too quickly. Spreads widen. Ratios compress. Physical markets stop aligning neatly with paper ones. People often describe moments like this as price explosions. But prices don't explode. Pressure does. And when pressure finally forces itself into view, it rarely does so where the system is strongest. It shows up where flexibility runs out, where responsiveness replaces stability. Silver didn't break the system. It simply showed us where the stress escaped. This is where it's important to slow down. Moves like this invite certainty, strong opinions, confident predictions. But markets don't reward certainty at moments like these. They punish it, especially when behavior has already shifted away from normal. Nothing about silver crossing $100 guarantees what comes next. What it does guarantee is volatility. And volatility doesn't follow scripts. If liquidity tightens further, price could continue moving in uncomfortable ways, both up and down. When markets reprice under stress, they don't pause politely. They overshoot. They correct. They surprise participants on both sides. That's not a forecast. It's a pattern. If, on the other hand, conditions stabilize, if policy shifts restore confidence, if capital finds relief valves elsewhere, silver doesn't need to collapse to disappoint expectations. It can simply stop behaving dramatically. Sideways movement after extreme acceleration often feels worse than a pullback because it drains narrative energy without offering resolution. History offers reminders, not instructions. In late 1979, silver accelerated rapidly, compressing months of movement into weeks. What followed wasn't an immediate end, but violent swings that tested conviction on every side. In 2011, a similar story played out. Enthusiasm gave way to instability long before consensus recognized the shift. The common thread isn't timing, it's conditions. Fast markets don't end because a price level is reached. They end when participation changes, when liquidity reappears, when pressure redistributes, or when belief becomes too crowded on one side. That's why this moment isn't about calling a top or declaring a new era. It's about recognizing that behavior has entered a different regime. And once markets enter that regime, discipline matters more than conviction, which raises a more practical question. If prediction isn't the goal, what should we be watching instead? When markets enter a phase like this, the instinct is to act, to decide, to commit to a narrative. But moments shaped by stress don't reward quick conclusions. They reward observation. So instead of asking what to buy or sell, the more useful question becomes, what should we be watching? The first signal is the gold-silver ratio itself, not the absolute level, but the direction and speed. If the ratio continues to compress smoothly, it suggests capital is still reallocating under pressure. If it snaps back sharply, that tells a different story, not necessarily relief, but redistribution. Either way, the ratio often moves before headlines catch up. The second signal is physical premiums, especially the gap between Western pricing and Asian markets. When premiums persist, it means demand isn't being deferred. When they fade, it often signals that pressure has found another outlet. This isn't about a single spike. It's about consistency. Third, watch velocity. Not just whether price goes up or down, but how fast it moves between levels. Markets under stress tend to move quickly in both directions. When price starts covering less ground per day, even without falling, it often means the system is regaining balance, or at least catching its breath. Fourth, pay attention to futures structure relative to price. When prices rise while open interest remains elevated, it suggests unresolved positioning. When open interest falls alongside price, it often signals closure rather than continuation. Structure tells you what enthusiasm hides. Finally, listen for changes in tone around liquidity and policy. Not announcements, tone. Markets often react to what policymakers sound like before they react to what policymakers do. Shifts in language about stability, risk, or temporary measures frequently precede real adjustments. None of these signals tells you what to do on their own. That's not their job. Their job is to tell you when behavior is changing again. Signals don't provide certainty. They provide awareness. And awareness matters most when the market narrative feels loudest and clearest, because that's usually when blind spots are largest. Which brings us to the final question. If silver at $100 feels unreal, what does that say about the system we've been using to price everything else? Silver at $100 feels strange for a reason. Not because it's impossible, not because it breaks a rule, but because it quietly exposes how accustomed we've become to treating money itself as stable, predictable, and obedient. For years, prices taught us to think in straight lines. Inflation here, growth there, risk carefully labeled and contained. Silver was supposed to stay in its place. Useful, secondary, explainable. When it didn't, the discomfort wasn't about the metal. It was about the framework we were using to understand it. If an asset long dismissed as just industrial can reprice this abruptly, what does that imply about the assumptions holding everything else together? Maybe the real question isn't whether silver belongs above 100. Maybe it's whether the system that priced it below that for so long still deserves the confidence we quietly give it every day. That question doesn't demand an answer, but it does demand attention. If this analysis resonated with you, consider subscribing to the channel. Not because we promise predictions, not because we chase headlines, but because moments like this, when markets stop behaving normally, are when understanding signals matters more than reacting to noise. This channel is about slowing the picture down, about looking past price targets and asking how money, power, and behavior interact when systems come under stress. Sometimes that shows up in silver. Sometimes it shows up somewhere else entirely. In the next video, we'll take this one step further, looking at how rising precious metals prices intersect with liquidity conditions and why gold approaching $5,000 may be less about optimism and more about insurance. If that's the kind of perspective you're looking for, subscribe so you don't miss it. And if you have thoughts on what silver at 100 really signals, I'd like to hear them. Drop a comment below. I'll see you in the next one.